That's true. And I think we're going to get a clue into why the fund did so well during that period in your pro pick. So let's get into it. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so we didn't touch on this throughout the whole show because I knew we would get to it in Pro Picks. It's your view on gold and precious metals. And am I right in saying that one of the reasons your fund did so well post-Liberation Day was because you had such a big weighting in gold, and gold did extremely well?
Yes, you're absolutely right.
And I can't think of an asset that draws out more emotional investing than gold. So you've built this AI model to cut out human emotion, and you're overweighting gold. Tell me why. Or what's screening so favorably? I know you can't tell me why, but what is so good about gold right now?
Well, to your point, gold is a very emotional, you have people that are gold bugs, I think is the term. Presumably most people or managers would buy gold stocks because they have a bullish view on gold. I do not have I might have a view on gold, but it certainly doesn't make its way into the way we
they're scared of something.
Stocks. Or they're scared of something.
Yeah. The AI model isn't scared of anything.
It isn't, but it doesn't own gold stocks because it has a bullish view on gold, unlike why most managers would own gold stocks. What it understands is that gold stocks are the only group of stocks as a group, never mind a single stock, but as a group or a subsector that has no correlation to the index. None. They don't. Even staples may be defensive, but they are correlated. If the market goes up 1%, they'll go up less. If the market goes down, they'll go down less. But they are correlated. They still go up and down with the market. Gold stocks are the only group of stocks that have no correlation. So back to that weighting ratio. What the model understands is that starting a couple years ago, there's several of these companies now that are screening. They've been positively raising their dividends consistently. They haven't cut them. But then when it comes to the weighting ratio, it understands mathematically their diversification value. Mm-hmm. That denominator is low because, as I said, they are the only group of stocks that have no correlation to the index. In other words, it's weighting them prominently, not because it has a bullish view on gold, but because it understands their diversification value mathematically.
And how that's manifested today in Pro Picks is through Wheaton Precious Metals. And so I'm curious about the weighting there, and if that's, that's more of a streamer. So if you've overweighted like the streamers versus the actual miners, or are you owning a basket of gold stocks? And you just told me about Wheaton Precious. How does that work?
Well, we own both. So we own Wheaton and we own Franco-Nevada. We own a little Kinross. So that's the stocks it owns, only because...
And are they up to 5%? You said each stock is capped out at 5%.
Two of them are at about 5%. Again, we haven't rebalanced yet. We will in about a week at the end of June. But it's looking like their betas have been picking up.
The volatility.
Which isn't surprising because I think when something becomes in vogue or in focus by the general investing public or by, fast money hedge funds, then they become what I call a hedge fund toy. You see the volatility start to pick up. So I wouldn't be surprised if in the next rebalance it took that weight down.
But still bullish. It's not.
It's still going to own them, but yeah. I would think they would have lower weights.
Okay, good perspective for our audience to look at those gold stocks, but maybe pull back a little bit on exposure. The second one is EMP.A, which is the grocery store. It's a consumer staple, owns Sobeys, Farm Boy, etc. Recently hit an all-time high.
Yeah, so we are overweight the staples, namely the groceries, the Loblaws, the Empires, the Metros. Again, when you think about them, they're very low volatility, not just mathematically. I mean, when you actually, this is not what we do, but The reason they're low volatility is, back to Liberation Day. Number one is they don't have a big cyclical beta, what I call. In other words, they're not particularly sensitive to recession. I mean, people need to eat. And chances are, if you need to eat, you're going to one of those three and maybe Walmart because we have a very entrenched oligopoly. The other thing is they're not really affected by tariffs. They don't sell abroad. Mm-hmm. And to the extent they have to import things, they can easily pass those costs through to consumers.
So you are capturing those soft factors
it's
in the
captured
denominator.
in the beta, yes.
Yeah, in the volatility.
Absolutely.
Because investors are pricing it in, and the model looks at how are investors pricing that in.
Exactly.
Okay, I'm starting to understand the model a little bit better. So then something like valuations or momentum, like where does that show up in all of this?
It doesn't.
It doesn't.
And a lot of people are quote unquote bothered by that. You mean you don't look at valuation or you don't look at the... So here's what I'd tell you. I think Charlie Munger said always invert. Warren Buffett's partner said always invert. So let's assume, here's what we know. We assume that S&P is correct in the sense when they say 85% underperform, let's just assume they're right, that they have good data and they've done their work properly. Fine. Now, this is a little bit of a leap of faith, but not much. Let's say of the several hundred managers in their database, let's assume, and I think it's a pretty good bet, that the vast majority of those managers are picking stocks and constructing portfolios by way of classic fundamental bottom-up, value investing, maybe a little macro overlay in terms of their view of the interest rates or inflation or growth. Fine. So we know that most of the vast majority underperform, and it's a pretty good bet that most of them are using the same tools, the same approach. Okay, so why would I want to do the same thing as everyone else that is leading to almost 90% of them underperforming?
So you're saying valuation doesn't matter?
It does matter. I like to say that Adam Smith always wins.
And for Adam Smith non-stands?
Like that Adam Smith who's been dead for 300
yes,
years. Yeah. In the sense that if it's a battle between, 100 of the best income statement balance sheet analysts on one side and Adam Smith on the other, he'll win every time because he knows, simple supply and demand, that they will arbitrage each other's competitive advantages away. The problem isn't that they're all trying to outperform. Seems like a worthwhile endeavor. That's not the problem per se. The problem is that they're all trying to outperform by using the same tools. And therefore, none of them can outperform.
So you've put that tool to rest.
So why would I want to do the very same thing that is leading the vast majority of managers to underperform? So back to your question, you don't look at valuations? Well, they are, but it's already in the price because they're all doing the same thing.
That's a good point. I never thought of it that way.
Adam Smith always wins.
That's a bumper sticker. I imagine if there was going to be a bumper sticker on your car, that could be one of them.
I hope I can keep winning when I've been dead for 300 years.
Yeah, that's timeless investing. Hopefully ProPick stands that test of time. Your last one here is Capital Power. That was interesting because that chart is like a little choppier. What is screening as attractive there?
Namely, the same things as everyone else. They've been steadily increasing their dividend. They haven't cut it, and their yield relative to their volatility, although to your point, the volatility has increased. So it'll be interesting to see. I haven't looked at our rebalance that's coming up in about a week, whether it picks up that extra volatility and they get downweighted.
Do you ever override the model? Do you ever look at it and say, what are you thinking?
No, I don't. And the reason being is presumably, well, not presumably, you've put all this effort, tremendous effort into building and refining these models, which you've found to have some value, to be able to add value, to do better than most. Then what would be the point if you've spent all this effort then just to ad hoc spontaneously override it? You might as well have not done it in the first place.
I guess, yeah, you have to rein in your worst instincts.
Yes, you do. You do.
Noah, it's been an absolute pleasure. Thank you so much for joining me on the show.